School of Management Studies IGNOU presents an audiobook on the course MMPC-013 Business Law for MBA program. Block 4 Legal and Regulatory Framework for Financing and Investments of Business. Unit 7 Banking and Other Allied Regulation. Part 1.
After completing this unit, you should be able to understand the evolution of banking regulation, explain the terms and conditions to be complied with for obtaining a bank license, discuss the interface of Banking Regulation Act with other laws, and describe the role of central government in regulating the banking sector in India. Introduction. Regulation of financial sector is extremely important, but within the sector, banking sector regulation is most important. The reason has to do with the importance of the role it plays in the economy, the fragile nature of the business model of the banks, and the consequences of bank failures as has been observed in most serious recessionary phases in recent history, including Great Recession of 2008. Banks not only serve as depository of people's savings but also serve as a payment mechanism. The payment system, which majorly runs on payment orders made to and checks drawn by us on our banks, runs on the assumption that the amount standing to our credit in the account is as good as real money. The agreement between the two parties to do an impossible act itself is void. A contract may also be void because of an event which makes the performance of promise impossible or unlawful after the completion of the contract. The amount shown in our account as credit is a mere debt due to us from the bank, which is repayable on our demand. Our confidence that it would be so paid whenever asked for, and the ability of banks in almost all instances to do so ensures that we treat it as good as money. But we tend to forget that the bank lends this money, and to cover for its cost of operations and the interest paid to us, it has to lend it at a higher interest rate, which would usually be for a fixed duration. Thus, we come to a situation where the bank has liabilities which are short-term in nature and assets which are long-term. This mismatch between the time frame of assets and liabilities is what underlies the fragility of the banking business. The business not only has to manage the liquidity but also ensure that the depositors retain confidence in the bank so that not only fresh funds keep coming in to match the payment orders and instructions, but also that the depositors do not lose confidence in the bank, as the loss of confidence would certainly cause a run on the bank, causing it to fail. A bank failure has an effect on all segments of the economy. The depositors not only lose their liquid assets but may even be the cause of failure of businesses which used the failed bank for receiving and making payments, for providing bank guarantees, or which had an overdraft facility on the back of the security given by them. This would now not be released anytime soon till the bank insolvency process is completed. This may even have a systemic effect if the entity is large. A bank failure may lead to a panic reaction amongst the general mass of depositors, leading them to withdraw deposits from other banks, causing a bank run. Healthy banks would fail if suddenly there is a run on their deposits. Depositors and businesses dependent upon them fail, and soon enough, an isolated instance of bank failure balloons into a system wide series of failures, as was experienced during the Great Depression of 1929 and Great Recession of 2008. The failures also affect the money supply floating in the economy as the banking system multiplies the money. The money in circulation due to the operation of the banking system is usually a few multiples of the base money, that is, the printed money or the issued coins. Evolution of banking regulation. After understanding the importance of banks in the economy and the necessity of regulating them more than other players in the economy, the question arises as to who is best placed to regulate the banks and the legal basis of the regulatory power. The first necessity for bank regulation came by the need for cooperation amongst the banks in executing payment instructions and making collections on the checks deposited with them. Instead of chasing each bank individually, it was thought fit to have a central place where the banks of a local area could meet, and instead of paying each check individually to another bank for the other bank's customers, only the net balance due to each bank be paid. So local areas had clearing houses. Since checks honored in the interim may bounce, either due to insufficiency of funds or signature of the purported check writer not matching, the collecting bank had to be solvent enough for return of monies in such cases. Clearinghouse membership was an informal regulation of the industry as it was dependent upon confidence in the solvency of the banks who met. But the role of industry-specific bodies in forming standards for the guidance of its members has over a period of time become more formal and recognized by courts in determination of industry standards for service. The fragility of the banking system meant that whenever there was a run on the banks, howsoever well run and solvent they might be individually, howsoever good their asset quality be, there would always be a chance that they might fail. No other financier would be willing to lend to the bank because it would be afraid that even if the money lent is not lost, it may not be available to it in times of crisis. So a need was felt for a lender of last resort in times of crisis, an entity willing to lend when no one is willing to do so because they are dependent on demand deposits to lend. The entity should not depend on retail deposits and have the power to create the money which is accepted as a valid tender. In the late 19th century, Bank of England emerged as a lender of last resort to the English banks. In the first decade of the 20th century, the Federal Reserve Board was formed to be the lender of last resort in the United States of America. During the Great Depression, a need was felt to have a lender of last resort. In pursuance of this strongly felt need, the Reserve Bank of India or RBI was formed in 1934. Basically, the structure followed was that the banks which wanted to be eligible to be considered for lending by the RBI had to maintain a certain percentage of their deposits with such lender of last resort, that is central bank, and had to observe prudent business practices to be considered for lending in emergency situations. It is like a bank exercising some control and surveillance over a borrower who has been given an overdraft facility. With banks having deposits with the RBI, it also has a role in the clearinghouse operations, thus giving it a bird's eye view of the working of the financial system and the solvency of the individual players. Regulation by perceptions of solvency and contract were thought to be insufficient. Regulatory power was not statutory, as though the entities like Bank of England or RBI may have come into existence either by charter or statute. The shareholders were private individuals. After the nationalization of Bank of England and the Reserve Bank of India, regulatory powers were given to the central bank in the same way as they could be exercised by the said executive wing of the government. The powers have been reserved with the executive wing of the government in some countries, but it was thought appropriate to give it to an entity which has expertise in the sector, which would anyway perform a regulatory role with regard to most of the banks because of it being the lender of the last resort and thus avoid duplication of effort. In this way, Banking Regulation Act 1949 gave the Reserve Bank of India the statutory regulatory power over most of the banks. The government retained for itself the role of giving directions where it found appropriate and being a forum for appeal for most decisions taken by the RBI. While RBI has the primary role in regulation of banks, it shares the regulatory space with certain other bodies. In the case of agricultural cooperative banks and regional rural banks, National Bank for Agriculture and Rural Development, that is NABARD, also has a regulatory role as it is the principal refinancing body for these banks, serving specific needs of a sector of the economy. In the case of urban cooperative banks, the principal means by which the RBI used to regulate was by being the lender of the last resort for the banks which were in the second schedule of the RBI Act. Recently, by amendment to the Banking Regulation Act, RBI has been given a primary regulatory role over these banks, almost at par with what it has in the case of commercial banks. However, it ought to be noted that cooperatives having been organized under the state statutes relating to cooperatives, the Registrar of Cooperatives of the State of Incorporation will also have a regulatory role, not so in the case of multi-state cooperatives. In the case of public sector banks, the regulatory role of the RBI is dependent upon how much of the regulatory powers relating to them is ceded by the central government to the RBI under the Banking Regulation Act, that is BRA. At present, central government has given the RBI almost all the powers over the public sector banks which the RBI has over the private commercial banks, with the exception of the powers over the board and other officers of the bank. We have considered the regulation by industry standards setting bodies, contractual arrangements for deriving of benefits, either as lender of last resort or refinancing arrangements or deposit insurance, etc., and by statute. Another source of regulation is the soft law framed by different international associations for regulators for the guidance of the member regulatory bodies. As far as banking is concerned, two transnational bodies are important. The first is Bank of International Settlements, Basel, and the Financial Action Task Force. Bank for International Settlements or BIS was originally a small body of central banks of developed economies, but its membership has recently expanded. The bank has as its primary remit the stability of the international financial system. After the Hastad crisis in the mid-1970s, when the failure of a German bank created problems for the payment systems in New York, BIS has sought to address the issue of how to ensure that the banks which are participants in the international payment systems and mechanisms stay solvent to honor their commitments. Towards this end, with the sanction of the member central banks, it has periodically made rules for calculation of the capital required by a bank for doing business. Though the rules are meant only for the banks engaged in cross-border payments and which belong to the member states, requirements of international trade and international payment system operation almost made it incumbent to most central banks to frame regulations based on the BIS guidelines. International trade depends upon letters of credit, and banks must have confidence in the letter of credit opened by its counterparty in another country to agree to become the payer on being presented the documents by the exporter. In a similar manner, the guidelines of the Financial Action Task Force FATF, formed for the purpose of curbing the use of the financial system for money laundering, are adopted by not just the member countries but also others who want their financial institutions not to be excluded from the international financial system. One has to remember that regulatory bodies acquire expertise in certain sectors of the economy. The legislature may want to use the expertise developed by these bodies for regulating the allied sectors. Sometimes it is necessary, as carrying out the responsibilities in one area may require an input from or a corresponding action in another arena of economic activity. Inactivity in the allied area may lead to the players exercising what many would call the regulatory arbitrage, that is, taking advantage of the absence of rules in the allied sector to carry on the same activity without checks and balances. Banks and non-banking finance companies or NBFCs are different. The deposits of the latter are not repayable on demand, and they don't act as the agent of their customers in the payment system and so don't form part of the payment system. But a very short-term deposit or commercial paper, as in the case of Lehman Brothers, which failed in 2008, may make them also very fragile. If the lenders to these institutions are banks, then the regulator for banks becomes interested in their solvency, more so if the banks form these NBFCs to bypass the regulatory barriers. That is why they are sometimes called shadow banks. As a result of this, the RBI was given the regulatory remit for the NBFC sector by an amendment to the RBI Act in 1997, when a regulatory vacuum in the NBFC sector was noticed after the failure of many depository NBFCs. Similarly, since the RBI has the remit to maintain the monetary stability, that is, stability in the value of the currency, it has the regulatory powers in the money market, that is, short duration loan and short-term debenture market under the RBI Act, monetary payment and settlement systems under Payment and Settlement Systems Act, and regulates the capital flows in the foreign exchange market under Foreign Exchange Management Act. Regulation in relation to chartering or licensing. Banking is a business of borrowing and lending money, but with special features which are absent in other borrowing and lending businesses. Not only are deposits with it repayable on demand, but they are repayable only in the branch with which the account is kept, and the bank also gives the check facility to its customers and would collect checks on their behalf. The last requirement means that the bank has to take a debt or deposit from its customer, and whenever the customer wants it, the bank cannot refuse it, as in case of ordinary debtors. Banking Regulation Act prevents any person or entity to give a check writing facility to its customers if the person or entity is not a bank. Further, It prevents the use of the term bank by any entity which is not a banking company registered under the Banking Regulation Act, though some entities use the terminology under the special statutes by which they are created or under which they are incorporated. While banks were in business long before BRA came to be enacted, a time frame was given for such banks to get the license to operate as a bank from the RBI. All new banks to operate as a bank needed a license from the RBI. The grant of a license is the discretion of the RBI, but the BRA lays down certain conditions for the exercise of its discretion, conditions which it is required to be satisfied about before granting of a license. The company must not only be in a position to repay present and future depositors in full as their claims accrue, but should have adequate capital structure and earning prospects along with the character of the proposed management and the conduct of its affairs, not being opposed to public interest or interests of depositors. In addition, the RBI will look into the public interest and availability of banking facilities in the proposed area of operations. While granting license, the RBI may lay down conditions to be fulfilled by the licensee when operating as a bank. Banking Regulation Act or BRA gives RBI wide amplitude in the granting of a license. The RBI has in recent times given out a policy paper on how it would exercise its discretion. The conditions for license for different types of banks are different as each of them would pose different risks to the financial system. At present, banking license for commercial banks are in three categories: payment banks, small finance banks, and full-fledged commercial banks. The first do not give out any commercial loans, while the second give loans only up to a specific amount allowed by the RBI, which is Rs 25 lakhs at present. Since the first and second categories of banks pose a lower risk, the licensing conditions are less onerous for them. The third category of banks has more onerous conditions regarding capital and character of the management. One change by the RBI in the latest policy statement is that from now on the bank licenses are to be on tap, provided the applicant meets its rigorous conditions for them, and it has also laid out a roadmap for payments banks to progress to small finance banks and then to full-fledged commercial banks. The RBI license is also required for the opening of bank branches, the definition of which is very wide in the BRA to take into account all payment offices. At present, such licenses are not individually given, but banking companies have been given general permission to open branches, provided a spatial distribution in terms of rural and urban branches is maintained. Foreign banks wanting to open branches in India are required to have a license from the RBI. The license is granted on the basis of reciprocity, that is, Indian banks can open branches in the country of incorporation of the foreign bank. The latest guidelines of the RBI provide that the foreign banks wanting to start a bank in India will have to do so through a subsidiary incorporated in India, as it wants to insulate the Indian limb of the business of the foreign bank from the fluctuations in the fortunes of the foreign bank in other jurisdictions. For any company to be licensed to operate as a bank, one essential aspect which is required to be looked into is its capital. Capital of the banking company will have two aspects: initial capital and capital in relation to business. BRA concerned itself only with the initial capital, and the amounts mentioned therein have only a historical importance, no longer relevant in the present times. RBI gives out the minimum capital the bank requires to have depending upon the type of bank license applied for. but also lays out the capital which a bank needs to have in accordance with the size of the business and the risk profile of its loan assets. This is in pursuance of the application of the norms agreed upon by the central banks in the Basel Accords. Basel Accords take into account the reality that the shareholder who controls the management has a limited liability. Because the liability of the shareholder is limited, the shareholder body has an incentive to push the management to take greater risk in lending so as to increase the shareholder returns. This risk-reward conundrum in a limited liability entity can only be broken by requiring that the shareholder put in additional capital where the risks are greater. So now the capital requirements of a bank are based on the size of its loan book and the quality of its loan book. Less shareholder capital is required when money is lent to the government. More capital is required when money is lent to an individual backed by the security of mortgage of self-occupied house, and most capital is required when an unsecured loan is given for a business. Basel norms also takes into account of balance sheet exposure of banks in the form of bank guarantees, etc. The Basel capital requirements refer to capital which is available to depositors of the bank as a cushion in the event of bank not performing well. The capital can be in the form of equity shares, irredeemable preference shares, and debt in form of debentures, that is convertible or non-convertible, or bonds which are subordinate to debt due to the depositors. The capital requirements can further be divided into Tier 1 and Tier 2 depending upon how permanent the capital is. Tier 1 comprises equity shares, irredeemable preference shares, and some debentures or bonds with the condition that their redemption is dependent upon the banking company fulfilling certain conditions and it wanting to redeem it.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC-013 Business Law. Course Coordinator Professor K. Ravi Shankar. Voiceover by Harpreet Kaur. Edited by Savita Rana. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.